Hey everyone, it's CJ here. Today I want to talk about a new net company that came across my radar. Every once in a while, I run a screen that will look for a company that is trading for less than its net cash position. So I'll take the cash and short-term investments, subtract the debt from that, and then see if that's less than the market cap. And a lot of these companies come up, and mostly they are companies in China, usually over the counter, and I'm no great expert in those types of companies, so usually I try to avoid them. But this one is a little bit different. I want to find out, is this company cheap, and is this company worth my time? This company is CCUR Holdings, and it used to be named Concurrent Computer Corporation or something silly like that, but they renamed in 2018. And they operate in a few business segments. One of them is the MCA, or Merchant Cash Advance business, and they also have some real estate operations. The Merchant Cash Advance business works a little bit something like this. So say I'm a small business owner and I need a loan right now, but I can't go to a traditional bank to get that loan. So I can sell, say, $20,000 worth of future credit card sales to a company like CCUR in exchange for basically a loan of, say, $15,000 or $10,000. And then once I receive that money, over time, I am automatically paying back that loaned money to CCUR. So companies like CCUR are basically lending money to small business owners and earning an interest payment on that lent money. Now, I don't know a ton about that business model beyond kind of the basic high-level concepts of it, but there could be some reputational risks involved. There could be issues such as price gouging with high interest rates, because sometimes small business owners, if you're not in a position to get a loan from a traditional bank, then maybe you kind of have to go for the only option, which would be a high interest lender like CCUR. But all that information could be found out in a deeper dive into the business of CCUR. The company has about a $25 million market cap. This company looks ridiculously cheap on a quantitative basis, so let's dig into the financials and see what the balance sheet looks like. Okay, so let's just go through a few different valuation situations for a company like this. Keep in mind the market cap is $25 million, so we'll be referencing that. As you can see, the cash and cash equivalents and short-term investments total for the last 12 months to be about $42 million. So already you can see that there's a pretty big gap between the amount of basically the most liquid assets possible on a balance sheet versus the market cap of the company. So we can also subtract all of their debt. So we can scroll down here. We see that they have $0.37 million of debt. So if we subtract that from the total cash, we're left with a net debt position of negative 42 million, which means that they have a surplus of $42 million of cash minus the debt. Now, a number like that just makes my eyes light up because this seems like a really cheap stock. So right away, we can see that it looks like the market is giving this company a negative value, because if we subtract the net cash position from the market cap, we're getting a number of negative 17. Of course, that doesn't really make sense at all. So already the valuation looks pretty ridiculous. I mean, the cash on hand and the short-term investments are 17 million greater than the current market cap. So there's about a 40% difference between the market cap and the actual amount of short-term investments and cash on hand. We can even take it from a more traditional net Benjamin Graham style type of assessment, where we'll take the total current assets and subtract the total liabilities. So here we can see we have about $47 million of total current assets, and then about $8.5 million of total liabilities. So doing some rounding, we can get a total asset value of about $38 million. There's about a 45% difference between the net asset value and the market cap. That's another pretty big gap in value versus price. Another metric we can look at is the total tangible book value to share price. So as we can see here, we have about $6 per share in tangible book value compared to $2.80 per share that the company is currently selling at. So based on price to book value, the company looks like it at least has a double in order to match the reported accounting book value. I do want to point out that we kind of need to take all of this information with a grain of salt, because if management is either unable or unwilling to unlock the value that's on the balance sheet here, whether that's through share buybacks or liquidation or other means, then it doesn't really matter how much cash this company has. It's very possible that they will continue to reinvest this cash and use it to fund either their MCA business or their real estate business. Because they have such little debt, I really don't know if management has the incentive to actually liquidate this company. I do want to point out that they do have a share buyback program and they bought back shares in 2018. I don't think they bought back any in 2020, mostly due to the adverse effects of the coronavirus pandemic. But even so, I looked into their annual report. It said that for now, at least, they're trying to move away from that business and move more into the real estate operations, which will probably require a lot more cash. And from the looks of it, the MCA business was more of a recurring revenue stream, which is kind of the type of businesses that I like to look for long-term compounding. So this type of business is definitely not a long-term compounder by any means. A company like this, I would not want to hold it for very long. I would want to wait for the market to revalue this company at its appropriate asset value and then sell it quickly. It's not a great business right now by any means. And that's clearly illustrated by the revenue trends of the company. So, I mean, they're losing money almost every year. They went from making in the $60 million ranges up until 2016 to the trailing 12 months, they're making $4 million so far in revenue alone. Their net income has slowly been declining over the years and they've had to stop paying a dividend. Although they did pay a special dividend of 50 cents per share at the beginning of 2020, I believe. So this company could go two ways. One way would be to basically liquidate the company as it is and try to capture most of that cash balance and redistribute it to shareholders. On the other hand, the company could continue to be a going concern, try to make more money by loaning money to small businesses and to fund real estate operations. One way is a surefire way to capture value, and the other way is going to be a tough slog, but it might pan out for them in the end. I do want to point out that there might be another misalignment of incentives. The CFO and CEO, which are Barr and Sutherland listed here, don't have that huge of a stake in the company. So Barr owns about 1% of the company and Sutherland also owns a little less than 1% of the company. So we could interpret that in one of two ways, really. I mean, one way, the cynical way, is that they don't have that much of a vested interest in this company. They might make all the moves to liquidate it, get the cash out of the business, pay themselves for their efforts, and just move on to something else. I mean, they're not spring chickens. I think they're at least in their 50s or something. But on the other hand, another way to look at this, which is even more cynical, is that they really don't give a damn what happens to the company. They're not set to make too much money from it or lose too much money either way. So it's very possible that they could mismanage the company going forward. But the past history of their share buyback program, among other things, kind of gives me hope that they're going to try to turn the business around in some regards. So best case scenario for us as investors is that they work towards a liquidation, but I right now don't have a clear picture if that is the direction that they're going. To find more information about that, the next step would be to look through the annual reports and figure out why the business is in what looks like a decline. So I would go to their website, grab their 10Ks, read through especially the business operations part and figure out what percentage of revenues are going to be coming from the real estate segment versus the credit loaning portion of their business. And it's easy to talk about liquidations as being the best case scenario for a company, especially for investors who just want to make money on this situation, but they're not as easy as it looks. For instance, Monish Pabrai was talking to Charlie Munger years back. Pabrai invested in Sears, and Munger basically said you should not be in that business because the liquidation is not going to happen smoothly and it's going to take a toll on all the employees, and it's just not good for anyone. It's probably best to not hope for the misery of others. So kind of keep that in mind if you're looking at businesses based simply on liquidation value. It's pretty infrequent that a liquidation just goes perfectly as you expect, no problems at all. So all in all, I'm keeping this company on my radar. I think they have a very favorable cash and short-term investment ratio to the market cap. Now, if they continue to reinvest into their business, that cash amount is going to keep dwindling, and it is possible that the cash will eventually become less than the market cap of the company. So that's a big risk with a company with a ton of cash. The market does not see the value that you can clearly see just from looking at the balance sheet. So that's where it will require us to dig deeper and read the annual reports and really figure out what's going on with the business and if it's worth putting our money where our mouth is. So at a high level, this company does look really cheap. Now, to answer the question, does it deserve more of my time? Well, that's another story. I mean, I could learn a lot from reading their annual reports, regardless of whether I'm going to invest in them or not. It should be pretty clear in the first annual report whether or not I think this company is going to be a viable candidate for putting a small portion of my money into. But if I had to make a decision right now, I would say no, I'm not going to spend more time on it. I'd rather spend my time maybe reading annual reports of other great companies like Amazon, Berkshire Hathaway, and Google. But if you are into nets, then this is definitely a company that has some potential. If you like this video and want to learn more about what a high quality business looks like, check out my video over here where I analyze and value Nintendo. Otherwise, please like the video and subscribe to the channel if you found this content useful. I really appreciate you watching this all the way to the end, and I will see you next time.